Business news at this hour. We wrap up still hearing more expectations on what is to come from the outcomes of the Reserve Bank's Monetary Policy Committee meeting, particularly a decision on interest rates, which stand at 5.5%. Now, the MPC meets for the third time this year and has been on a repo rate hiking cycle since late last year, while inflation has reached that 13-year high. But the latest consumer price inflation has seen a drop by 0.2% to 7.6%. It does, however, remain well above the central bank's target range of between 3 to 6%. And due to that, analysts are still expecting an interest rate hike, which will add pressure on the already burdened South African consumer. We are joined now by Mervyn Abrahams from the Pietermaritzburg Economic Justice and Dignity Group to unpack this matter further. Thank you so much for your time, Mervyn. I think the starting point would be the pressure that the South African consumer is under. What is expected in terms of an effect when it comes to yet another interest rate hike? Analysts are pacing it and pegging it at around between 50 and 75 basis points of a hike.
Good morning, Tumisang, and good morning to all your viewers. The impact of another 75 basis point interest rate increase will have a negative impact on South African households. I mean, currently, most South African households have got very large portions of debt that they are carrying, partly because of COVID-19, partly because of the fact that they have taken cuts in salaries and incomes, and are using debt actually in order to purchase essentials like food and pay for electricity and transport. And an increased interest rates will hit them extremely hard. Another thing that we need to look at is that our economy, our GDP has shrunk by about 2%, by 0.2%, and an increased interest rates will, in our view, lead to a greater shrinking of the GDP, meaning that our economy will become smaller, and that possibly could have the likelihood of further job losses as we go forward.
So, Mr. Abrahams, how do you then respond to a view that the central bank doesn't necessarily have a choice solely because South Africa's inflation remains at record highs, and we saw that in the fuel as well as food price inflation in the latest CPI numbers, that affects South Africa's poorest. It's gone up, although inflation has gone down and fuel decreases we've seen in the past 2 consecutive months. However, if we do not counter inflation, then it means it does not hit the middle class or those who are high income earners the hardest, but the same consumers that have been burdened and called cash strapped in South Africa for quite some time now.
Tumisang, we have to recognize that most of the inflationary pressures that we have seen over the last few months are in fact imported inflationary pressures, not locally produced ones. So food prices have increased massively because of what has happened in Russia and the Ukraine. And of course, fuel prices have also been linked to that. Now, over the last 3 months, we have seen that global food prices are commodity prices are beginning to come down. We have seen fuel prices coming down. And all the indexes are showing a decrease of inflation. So, for instance, Stats SA CPI has shown a 0.2% decrease. Our household affordability index over the last 3 months have also shown a much lower level of inflationary increases from 1.8% to 1.2% to 0.6%. So what we are seeing is that inflationary pressures are coming down. Whether interest rates are hiked or not, in our view, will actually not have any impact on inflation. And the reason for that is that if we hike interest rates, we then expect the value of the rand to increase versus the dollar, and that means that we can buy cheaper goods on the global market. But with all the interest rates we have seen this year, we have not seen a significant strengthening of the rand versus the dollar. So we don't believe that that is actually going to happen in reality. So what we are going to see is we are going to see higher debt charges, less money in the pockets of ordinary consumers, and still carrying part of this inflationary pressure.
Now, based on those elements that you've raised, what is the expectation of your organization from the Reserve Bank, especially because there's that existing conversation around what more the Reserve Bank should be doing to cushion the South African consumer, as opposed to focusing on countering inflation as well as monetary policy and fiscal policy?
So, Tumisang, our view is that the Reserve Bank has already increased interest rates, since the late last year, that it should allow that to work through the economy by not increasing interest rates again this time, see how the inflationary pressure come down over the next few months. But actually what we should really be focusing on is the question with the global commodity prices coming down. We've seen it at the pump, but we are not seeing it in food prices, which is our main inflationary driver. So we should be exploring why are food prices not coming down, and at what part of the food value chain is actually that stubbornly high inflationary level, because after 3 months of lower commodity prices, lower fertilizer prices, etc., fuel prices, etc., we should be expecting that food prices should be coming down as well. Now, I know that that's not the responsibility of the Reserve Bank, but it should be part of what the National Treasury and the Competition Commission should be doing.
Thank you, as always, for your time. Mervyn Abrahams is with the Pietermaritzburg Economic Justice and Development Organization, the coordinator there, talking to us about expectations ahead of the Monetary Policy Committee outcomes, where interest rates will be decided in South Africa.